Hey traders, Nick Sheehan here looking at 3M. I just saw something on CNBC and I just wanted to address it. Somebody said unusual options activity in 3M, blah, blah, blah. So let's talk about levels. I know there were some valid fundamental reasons why they sold it down regardless. They're probably still there. But technically speaking, this looks like a potential spike because it looks like a cup down here and a small handle. A large handle rather, and they're at a neckline from which they can break out. You can also consider inverse head, the bottom inverse head and shoulders, which is also bullish, which probably gives you about $10 rally-ish, 10, 12, depends where you draw the line. What happens is whenever they attack a neckline over and over, once they break through the neckline, especially that they're doing it from higher lows, the concept is they overshoot higher. The buyers will overwhelm the sellers and they overshoot higher. This is a candle to note how it kind of like an island and then fell back. So this is a candle still in development. The market's still open today. This is a 240-minute candle. So I think it's worth it to expand the chart to show. So this on itself is a bullish setup. I don't chase it until I have a clear breakout above it and a close above it, ideally, and a retest of the neckline. But you may miss a lot if one does that. So here's a 1 year daily. So here's my point that really scares me about the triple M. So if I want to mark it up, there's one simple point I want to make. I have nothing against the company itself. I really don't know their fundamentals that well, but I'm just saying something about the chart. All right, here's where it is, right? This is the opportunity. If I look left, this is the Christmas debacle. That's the Christmas debacle, basically, the end of December stock market debacle. This company just got back to that level. You know, that was a disaster, right? And they just got back to it when the market not only bounced off of this through the October level, they made all-time high, the market. This one failed to make the all-time high, and now just getting back to the worst spot in the market in years. I don't know if this is something I want to personally chase. So I would place a mark right here. I would want to see what they do in this zone. I covered it up. There we go. This zone right here, it's never a hard line in the sand, almost never. So, you know, the absolute value is 177 and change, or 177. I could argue that 178, 179 is a better gauge. I can argue that the whole zone here is because they overshoot down and up. So, great action. Probably not a place for me to start long until I see what happens here at this level. So let's call it through here. That's my personal opinion. As far as fundamentals are concerned, we can find out real quick. From a PE perspective, probably is a good gauge for this one. 18 PE, not cheap. It's more expensive than Apple, I bet you a little bit. And 3 times sales, slightly less expensive than Amazon at 4 times sales, but Amazon's PE is 80. So I don't know. It's not screaming cheap from a PE perspective. So definitely, I personally would not chase it until I see how they resolve this situation right here. All right, next signing out. This was it. Short point.